Hey, hello everyone. Hello everyone. Good morning. How are you all? Good morning, everyone. So, my name is Afri Nasmat and I welcome you all in today's session. How are you all? Is everything is fine? Audio and video, just please confirm first before starting the session that everything is fine. Audio, video, everything is fine. Hello everyone. Hello, good morning. Good morning, everyone. Good morning, guys. How are you all? Good morning. Okay, hello, good morning, Pratik. Thank you so much. Thank you. Audio is fine, video is working fine. So, today is the session of the previous year question. I will be discussing the previous year questions of IE and IFS. Okay, so I am your economics and PPB educator in English medium in JAB category. So, I welcome you all in today's session. This is the first YouTube live session with all of you. So, how are you all? Just uh, before starting the session, I'm just asking, everything is fine. How are you all? Okay. So in today's session, we will be discussing about all the previous year questions in detail, the topics in the previous year questions of IEIFS. And so let's start the class with the very first question of the class. The very first question of the class is, which of the following is or are considered as the promoter of NSDL. So we have four options. First is Industrial Development Bank of India. Second is Unit Trust of India. Third is sorry, BSC, and fourth is NSC. So the answer is everyone. Sakesh Kumar, good morning. Good morning. Okay, so the answer is NSDL. Which of the following organization is or are considered as the promoter of NSDL? So what is NSDL? It is National Securities Depository Limited. National Security Depository Limited is the first electronic security depository of the nation. Okay, it was established in the year 1996 and it has its headquarters in Mumbai. So, which of the following is or are the promoters of the NSDL? So, the correct answer is Sakesh is saying A, only third and fourth. And everyone else, okay, everyone just please answer the question. Okay, so if we discuss about the NSDL, because it is the first national electronic national depository of India, which was established in year 1996. NSDL or NSDL were promoted by IDBI, were promoted by UTI, Unit Trust of India, as well as NSC. These three are considered as the promoters of NSDL, while BSC is considered as the promoter of CSDL. CSDL is Central Securities Depository Limited. It was also established in year 1999. So NSDL have the promoters like NSC, UTI and IDBI. Okay, right? The CSDL have the promoters like BSC. Clear? So the correct answer is first, second, and fourth. D is the correct answer. Done? Everyone? Okay? Done? Any doubt? Okay, good. So the next question is CTGMSE. First, write the full form of CGTMSE in the comment section, please. So, CTGMSE is a financial initiative in India which aimed at providing collateral free credit facility. Okay, it doesn't apply to which of the following: micro enterprises, small enterprises, medium enterprises, or it is applicable to all. Okay, so there is a concept of micro, small, and medium enterprises, as you all know. So there are certain criteria which define micro enterprises, which define medium enterprises, as well as the small enterprises. So there are two criteria. First is the turnover criteria and the second is investment criteria. I will be discussing it, but let's first discuss about the question. CGTMSE, the full form of this is, everyone, Central Guarantee Trust. Okay. See, it is credit. Credit Guarantee Fund Trust for micro and small enterprises. For what? Micro and small enterprises. It is Credit Guarantee Trust Fund for micro and small enterprises. So obviously the word itself says that it is for the micro and the small enterprises. So obviously medium enterprises doesn't applicable here or doesn't cover under this credit guarantee scheme. So under this scheme, actually the collateral free loan, or you can say collateral free assistance, is given to small as well as micro enterprises. Okay, so it has been given to small as well as micro enterprises. Medium enterprises are not covered under this credit guarantee scheme. The cap of the loan, or you can say the maximum loan of the interest free or collateral free loan, is up to 1 crore. This scheme offers up to 1 crore loan for the small and micro enterprises for obviously their development, for their production ease and everything. So the correct answer is medium enterprises doesn't cover under this category. Clear? Done? Okay, okay. So, what is the difference between micro, small, and medium enterprises? I have listed it here. So, there are two criteria under which a certain a certain industry, or you can say a certain enterprises, is defined under these category. First, investment. If the investment in the plant and machineries and equipments doesn't exceed 1 crore, and the annual turnover doesn't exceed 5 crore, then the company or the enterprises is termed as micro enterprises. So here the investment should not be more than 1 crore and the annual turnover should not be more than 5 crore. Okay. Second thing is, what is a small enterprises? Small enterprises is the enterprises where the investment in plant and machinery does not exceed 10 crore. It doesn't exceed 10 crore, as well as the annual turnover doesn't exceed 50 crore. Then it is termed as small enterprises. And the updated criteria for the medium enterprises is the investment doesn't exceed 50 crore, as well as the annual turnover doesn't exceed 250 crore. So this is the criteria for micro, small and medium enterprises. Again, it is a very important thing for all of you. Okay, done. Okay. So these are the updated classification as per 2020 for the micro, small and medium enterprises. Clear? Done? Good. So the next question is, what happens when a company spends more than the stipulated amount of their net profit on corporate social responsibility in any year? So what happens if a company spend more than what should be spent in on the CSR responsibilities in any year? So what is the criteria, or what happens then? So the correct answer is, there are four options. Please answer the question correctly. Just read the answer, just read the question and answer it correctly. Okay. Limit is increased. Yes, it is the updated 2020 version. Don't worry, Sakesh. Okay, correct answer is corporate social responsibility spending obligation. So, in an year, actually, if we go by books, then the companies are free to spend more than their 2%. They are free to spend any amount, but the actual amount set is 2% of their net profit. So the company should spend 2% of their net profit on the corporate social responsibility. But it is up to the companies. They are free, they are allowed to spend more than that if they want to. And if they spend more than that, if they spend more than that, the excess amount is then set off for the coming year or the future year. So the excess amount that the company spend, if they spend 2%, more than 2% of their net profit, the excess amount can be set off against the CSR spending obligation in the future year. Okay, so it can be set off in the future year. Okay, so simple thing is, what is the criteria? It is 2% of the net profit. If they spend more, then it can be adjusted. Clear? Done? Okay, Ravi, Sakesh, Pratik, everyone. Done? Okay, please like and share the video, everyone. Just please like and share the video, everyone. Done? Okay, so next question is, which of the following statement best describes the term spot price in the financial market? What is the spot price? The price of a financial instrument for delivery in the future. Okay, next, the price at which financial instrument is sold shortly. The current market price of a financial instrument for immediate delivery and settlement. The average price of a financial instrument over a specific period. So, what is this term spot price means in the financial market? Please answer the question, everyone. Spot price. What is the term spot price meant? Okay, Ravi is saying C, and everyone else? Everyone else? Okay, so the correct answer is, okay, Amitabh is saying C. Yes, obviously, spot price. In simple terms, if you ask what is a spot price, in a very simple word, the price at which the buyer and seller values an asset right now in the present moment or in the present time, then it is known as the spot price. What is a spot price? Spot price is the current market price of a financial market for immediate delivery and settlement. The current valuation of an asset for which a buyer and seller agrees to settle, that is known as the spot price. So the correct answer is C. C is the correct answer. Okay, done. Done. Clear? Okay, next question. Which of the following is incorrect regarding various financial institution and instruments in India? So, which of the following statement is incorrect? You have to just answer the incorrect statement. First statement, NBFMFI stands for non-banking financial microfinance institution, and they are not allowed to accept public deposit. Second, mortgage guarantee is an instrument where the guarantee is provided for the loan against residential properties. Third is IFC, or you can say International Finance Corporation, is a subsidiary of RBI. 4. NBFCs means non-banking financial companies primarily engage in lending and investment activities. but cannot accept demand deposit? It's a very easy question. Okay, Pratik is saying C. Pratik is saying C, and everyone else? Pratik is saying C. Everyone else? So the correct answer is, so first statement. Okay, let's discuss the first statement. NBF, that is non-banking financial microfinance institution. These are actually the microfinancial institutional which are not allowed to accept public deposit. They serve as the microfinance institution. They provide microfinance services, but they cannot accept public deposit. Yes, it is correct. So first statement is perfectly correct. There is nothing wrong in the first statement. Second statement says that mortgage guarantee is an instrument where the guarantee is provided for the loan against residential property. Yes, it is correct. Yes, it is correct. Third. Okay, third is saying IFC. International Finance Corporation is a subsidiary of RBI. Correct or not? So, no, it is not a subsidiary of RBI. So, IFC, International Finance Corporation, is a subsidiary of World Bank. So, World Bank Group consists of five institutions: IBRD, International Bank for Reconstruction and Development; IDA, International Development Association; IFC, International Finance Corporation; MIGA, Multilateral Investment Guarantee Agency; ICSID, International Center for Settlement of Investment Disputes. So these are the five institution, or you can say subsidiary, under a World Bank. So IFC is not under RBI, it is under the World Bank. So the third statement is wrong. And fourth statement is perfectly correct. Why? Because NBFCs, non-banking financial companies, these performs the function just same as the banks perform. But the only difference is non-banking financial companies doesn't accept public deposit, which a banks does. Okay, so NBFCs, they provide loan, they provide other banking services also, but they can't accept the public deposit, which a bank does. And this is a very important difference between NBFCs and a bank. So the correct answer for this question is C. C is the incorrect statement. Okay, done? Yes or no? Clear? Everything is clear? No doubt? Okay, can we move to the next question, everyone? Pratik, Tejas, Ravi, Sakesh, Amitav, everyone. Okay, can we move to the next question? Okay, yes. See, what is the next question? Universal banks in India were recommended by which of the following committee? So, which of the following committee recommends the universal banking concept in India? We have four options: Narsimha Committee, Raghuram Rajan Committee, the Nachiket Moore Committee, or SS Tarapur Committee. Okay, these four committees are important, by the way. Each committee has its own recommendation in the banking as well as economy section. So, universal banks in India are recommended by which of the following? Please answer the question correctly. Okay, so Ravi is saying A, Sudarshan is saying C, and Shabana is saying A, Sakesh is saying good to go. Okay, so the correct answer for six, universal bank. Okay, what is the concept of this universal banking? A universal banking is the type of bank which participate in any form of banking activities. They can involve in any form of the banking activity. They works as a financial commercial bank, as an investment bank, they can serve you with the product like insurance and other financial services. In short term, universal banks perform all the functions of the commercial bank as well as the investment bank. They can offer you varieties of different financial services. So this is known as the universal banks. Okay. So Universal Bank in India has been recommended by Rajan Committee. Okay, Raghuram Rajan Committee. These committee recommend the universal banking system in India. Okay, Narsimha Committee. See, Narsimha Committee focuses on the banking sector reforms in India. So if we talked about the banking sector reforms in India, these are recommended by Narsimha Committee. SS Tarapur Committee, a very important SS Tarapur Committee introduced the Banking Codes and Standard Board of India. So BCSBI, Banking Codes and Standard Board of India, these are recommended by whom? So these are recommended by SS Tarapur Committee. Clear? Okay. Okay. Then the more committee, it dealt with the financial inclusion. Okay. To include everyone financially, the different programs which can be introduced for the financial inclusion. More committee recommended this. Okay. Narsimha committee dealt with the banking reform sectors in India. Okay. And Rajan committee, it introduces the concept of universal banking in India. Clear? Okay, done. Okay, see, next question. In which stage of the economic cycle do prices typically remain low due to the balance of money supply and demand? We have four options: expansion, peak, contraction, or growth. In which stage of money supply do prices typically remain low? So in which of the following stages the prices it is at lower point, or you can say the prices is low in the economy? Please answer the question, everyone. Sakesh and everyone. Shabana, Sakesh, Pratik, please answer the question. So the correct answer is, so the correct answer is D, D, draw. Okay, yes. See, in contraction as well in the trough phase, in both these phases, the prices are low. But when we talk about the contraction phase, the contraction phase is the phase where the prices are not typically at their lowest point. Here, the prices are low, but not at the lowest point. The economic activity slow down, so the prices are low, but not at the lowest point. But true is the phase where an economy hit at the lowest point. Lowest point means the demand is very low and the demand is hitting at the bottom, and due to the which the prices also hits at the bottom. So D is the correct answer for this question. Clear? Okay, done. Clear everyone? Okay, next question. Okay, please answer the question, everyone. So it is a very good question. It is the national income question. Which of the following formulas correctly represent to calculate net domestic product at factor cost? Okay, so it is a very good question. NDP at FC. Please answer the question, everyone. NDP at FC. Okay, Sakesh is saying C. And everyone else NDP at FC. See, so the formula of the market price and factor cost. Let us first discuss what is market price and what is factor cost. Market price is the price at which a product is sold in market. That is market price. And factor cost is the cost at which a product is produced in the economy. So the production cost is the factor cost, and the price at which it is sold in the market, it is known as the market price. Okay, so the formula is factor cost. If we add all the indirect taxes in the factor cost, and if the government offered any subsidy in the product, we reduced this subsidy from here, because obviously subsidy decline the price of the product. So if we add all the type of indirect taxes and reduces the subsidies, then we get what? Then we get the market price. Okay, so factor cost plus all type of indirect taxes minus all type of subsidies which are provided by the government, then we get market price. Okay, so for factor cost, market price minus indirect taxes obviously, and plus subsidy. So if we want to achieve factor cost from the market price, we will subtract all indirect taxes and add all type of subsidies here. So question, see question, net domestic product at factor cost. The formula for NDPFC. Okay, so NDPFC. See, first option says that NDPMP minus indirect taxes. See, market price, if we subtract indirect taxes and add all type of subsidies, then we get, of course, NDPFC. From market price, we will get the factor cost. How? If we add all indirect taxes, sorry, minus all indirect taxes and add all type of subsidies. So obviously, first is the correct statement. Done? Yes or no? Done? Any doubt? Clear? Done? Good to go? Any doubt? Any doubt from here? Clear. Okay, so next question. What is the term used to describe the grants in aid specially given for the creation of capital assets? So, what is the term used for the grant in aid which is especially given for the creation of the capital asset? We have four options. So, the correct answer is, please answer the question, everyone. Sorry. Hmm. Okay, so the correct answer is, please answer the question, everyone. Okay, see, what is fiscal deficit? First, what is fiscal deficit? Fiscal deficit is simple when we subtract total expenditure and total income. But in income, we exclude all the what? All the external borrowings. So if we exclude all the external borrowings, and then whatever income is left, and we subtract it from the total expenditure, then we get the fiscal deficit. Okay, next, what is primary deficit? See, primary deficit is fiscal deficit. Fiscal deficit of the current year minus all the interest paid on the last year loan. Okay, so how we get the primary deficit? It is fiscal deficit minus interest payment. Okay, revenue deficit. What is revenue deficit? Revenue deficit is simple. Revenue expenditure minus revenue income. And what is effective revenue deficit? It is revenue deficit minus grants given for the creation of the capital asset. It is revenue deficit minus whatever grant is given for the creation of the capital asset. So the correct answer for question number 9 is B. B is the correct answer. Clear? Done? So see, fiscal deficit is total expenditure minus total income, but excluding all types of external borrowings only. Okay. Next, primary deficit is what? Fiscal deficit minus all type of interest payment. What is revenue deficit? It is revenue expenditure minus revenue income. And what is effective revenue deficit? Is revenue expenditure minus all type of grants given for the creation of the capital asset. So the correct answer is D. Done? Clear? Okay. So next question, 10th question. Which of the following credit rating is yeah, simple, match the following correct rating with their meaning. Match the following. The correct rating means triple A, triple B, and C. These are the ratings and these are the statements. Match the following with the ratings with their explanation. Simple. So the correct answer is, please answer the question, everyone. Okay, please keep liking and share the video, everyone. Just please like and share the video, everyone. So, Praful is saying 10th C. C. You are saying C. Everyone else? Okay, so the correct answer is Amitabh is saying C. Okay, Shabana is saying B. Okay, C and B. You are all confused with these two options, C or B. Okay, so the correct answer is between C and B only. So the answer is, everyone. Okay, everyone just please answer the question. Okay, so triple A. What does this triple A means? Triple A, it denotes high safety, means no risk involved, high safety in terms of timely payment of interest and principal, where risk is not involved, then it is AAA. Okay. A, it denotes adequate safety, means some sort of risk may or may not be involved, but adequate safety for the timely payment of interest and the payment. So second is A. Okay. Now, what is triple B? Triple B denotes moderate safety. So adequate safety is A, high safety is triple A, moderate safety is triple B, as well as the substantial risk is C rating. So C rating denotes the substantial risk. Okay, and triple B denotes the moderate safety. So the correct answer is first B, second A, third D, and fourth is C. So the correct answer is B. Okay, done. Done? Okay, see, next question. Choose the correct statement regarding call and put option. So, what is call and what is put options? Choose the correct statement. We have four options. Please read the options carefully and answer the following question. Okay, see, read the question carefully. So, a call option gives the holder the obligation to sell a stock at a specific price. Second, a put option gives holders the obligation to buy a stock at a specific price. Third, a call option gives the holder the right to buy a specific stock at a specific price, while a put option gives the holder the right to sell at a specific price. So the correct answer is, please answer the question. So the correct answer is for call and put option. The correct answer is C. In the first and the second statement, the word first obligation is used. So call option and put option, it is not obligatory. First thing, it is not obligatory. It is the optional thing. Second thing, whenever we are talking about the call option gives the holder the right to buy a stock at a specific price. He or she is not under any obligation. It gives the right to buy the stock at a specific price. And if we are talking about the put option, again, it is not obligatory. It gives the holder the right to sell the assets at a specific price. Clear? So, third and fourth statement is perfectly correct. But first and second statement are wrong. And because of the two reasons. First of all, call is not selling. A call is buying option and a put is selling option. First thing. Second, it is not the obligation, it is the right. It is not the obligation. Clear? So the correct answer is D, third and fourth. Choose the correct statement. Third and fourth is the correct answer, means D is the correct statement. Clear? Done? Yes or no? Good. So, next question. Choose the incorrect statement. You have to choose the incorrect statement. See, first, a close-ended fund scheme is the one that is available for subscription and repurchase on a continuous basis. This scheme does not have, means close funded, does not have fixed maturity period, and investor can conveniently buy and sell unit at net asset value per unit. Second, an open funded scheme has an stipulated maturity period, that is 3 to 5 years. This fund is open for subscription only during a specified period at the time of launch. So, which of the following is the incorrect? You have to choose the incorrect statement, not correct. Incorrect statement. Please answer the question, everyone. Choose the incorrect statement. You have to choose the incorrect statement. Please answer the question, everyone. The incorrect statement. Okay, everyone, just please answer the question. Okay, see, what is a close ended fund and what is an open ended fund? If you read the statement carefully, you will all get that the statements are interchanged. Actually, these statements are interchanged. Okay, why? Because, see, not a close funded, a open ended fund or a scheme This do not have an fixed maturity and it is available for subscription and repurchase. So open-ended fund, technically it is not available for the specific period. It do not have any fixed maturity and investor can conveniently buy or sell this unit which are declared on a daily basis. But in an close funded scheme, in an close funded scheme, there is a time period, there is a fixed maturity. Okay, so this is for only for a specified period of time at the launch of the scheme. So actually the incorrect statement is both 1 and 2 because these are interchanged statement. Okay, okay, done. Okay, done. So moving to the next question. Okay, see, what is the next question? Calculate the insurance density based on the following data. Calculate the insurance density based on the following data. GDP 500 trillion rupees, GVA 400 trillion rupees, total population is 100 million and total insurance is 2 trillion rupees. So the correct answer for the insurance density is simple. What is insurance density? First, what is insurance density? Second, you have to answer the question correctly. Okay. Okay. See, the answer is what is insurance density? So, insurance density is what? Is the premium per population. What is insurance density? It is the total insurance premium per the population. Okay, that is known as what? That is known as total insurance density. So simple. If we see that total insurance premium is 2 trillion. Okay, so 2 trillion, see, so this is 2 trillion. Okay, and see, population is what? Population is 100 million. Okay, so population is, so this is what? This is population. See, simple. Okay, so the correct answer is 20,000. So the answer is A. Done. Very simple. You have to just learn the formula of insurance density. Is what? It is the total insurance premium per population. So the correct answer is A. Done, everyone. Okay, so any doubt from here? Any doubt? No doubt? Done? Good. See, next question. What is the extent up to which FDIs, foreign direct investments, is presently permitted in the insurance sector? So, after the introduction of different reforms, so early in the earlier stages before the LPG policy, there was the restriction of FDIs in the insurance sector, as you all know. But after the introduction of certain reforms, and because of the liberalization and globalization, foreign investments are allowed in different sectors of the economy, but with a certain limits, obviously. So, in insurance sector specifically, what is the extent of FDIs which are permitted under the insurance sector? 26, 49, 74, or 100%. So the correct answer is Hanji. See, what is the correct answer? Yes, obviously, the correct answer is 74%. It is a factual question. Okay, done? Simple. Okay, next question. See, the Dash act as a self-regulatory organization in the mutual fund industry. Very easy. Okay, which of the following act as a self-regulatory organization in the mutual fund industry? We have four options. IRDAI, Insurance Regulatory and Development Authority of India; RBI, Reserve Bank of India; SEBI, Securities and Exchange Board of India; and AMFI. So the full form is Association of Mutual Funds in India. So the correct answer is obviously Association of Mutual Funds in India. AMFI is the correct answer. Okay, the headquarter of AMFI is in the headquarter Mumbai. Okay. SEBI and RBI, you all know. IRDAI, it is a regulatory body for the insurance sector in India. Insurance Regulatory and Development Authority of India. So the headquarter of IRDAI is in Hyderabad. The headquarter of IRDAI is in Hyderabad. AMFI, Mumbai. And AMFI act as a self-regulatory organization for the mutual funds industry in India. Okay, done. Okay, see, next question. Under the Prime Minister's Suraksha Bima Yojana, what is the risk coverage amount provided for accidental death or full disability? Okay, what is the risk coverage? Very easy question. Factual. This question is factual. Prime Minister Suraksha Bima Yojana. See, the correct answer is so, Prime Minister Suraksha Bima Yojana, this scheme is offered by the public sector general insurance companies. So, these are offered by what? Public sector general insurance companies. And the risk coverage for the full disability or the death is 2 lakh, and partial disability, the risk coverage is 1 lakh rupees. So the correct answer is 2 lakh. 2 lakh is the correct answer. Okay, C is the correct answer. Yes, Pratik. Yes, Maharishi. Yes, 2 lakh is the correct answer. Done? Okay, good. Next question. Choose the correct statement. Okay, choose the correct statement. See, very easy question. Choose the correct statement. Okay, bank assurance is defined as selling of insurance product through NBFCs only. Next, the concept of a bank assurance, has roots in France. It commenced in India in the year 2010 when the government issued a notification under Banking Regulation Act, which allowed Indian banks to undertake insurance distribution businesses. So choose the correct statement. Very easy question. Choose the correct statement. Everyone just please answer the question. Okay. So the correct answer is okay, first thing is, what is bank insurance? Bank insurance is defined as the selling of insurance product via the bank, commercial bank networks. So it is not with the NBFCs, it is with the commercial banks and NBFCs, everything. So, first statement is wrong. It includes the commercial bank thing, also network also. The concept of bank assurance has roots in France, yes. Second, it is commenced, yeah, it commenced in the year 2010. No, actually, it was introduced in India in year 2000. So, the correct statement is second only. First and third is the wrong statement. Okay, done. Done? Okay. Moving to the next question, 18th question. Which organization is responsible for regulating the Atal Pension Yojana? Which organization is responsible for the Atal Pension Yojana? We have four options: RBI, Reserve Bank of India, Pension Fund, Regulatory and Development Authority, Insurance Regulatory and Development Authority of India, or CB. So the correct answer is very simple. Atal Pension Yojana is regulated by Atal Pension Yojana is regulated by. Everyone, please answer the question. Atal Pension Yojana has been regulated by obviously Pension Fund and Regulatory Development Authority. So it is a scheme launched by the government of India for the special unorganized sector worker. So unorganized sector worker, anyone who is registered under this scheme can get the guaranteed pension of rupees 1000 or 2000 or 3000 or 4000 after attaining the age of 60 years. Okay, this will be after attaining the age of 60 years. Okay, this is Atal Pension Yojana, and Pension Fund Regulatory and Development Authority of India organize this. Okay, done. Done. Good. Next, under the Employees Provident Fund EPF, dash percent of the contribution goes to EPF account, while dash percent goes to the employee pension scheme. So employees provident fund scheme is compulsory scheme for any company which have employees which have more than 20 employees. Okay, so EPF, the contribution is what? EPF, the contribution is what? So it is a private sector scheme. It should be, yeah, it is the obligation for every company which has more than 20 employees. Okay, it is under the Ministry of the Labor Organization or Ministry of Labor. Okay, so the percentage, what is the percentage goes to the EPF and what is the percentage goes to the employee pension scheme? The percentage, so it's 3.67%. 3.67 goes to EPF account, while dash percent 8.33 goes to employees pension scheme. Okay, done. So A is the correct answer. Done. Done, everyone. Okay, so the last question, 20th question. Treasury bill in India generally doesn't come under which of the following maturities? So treasury bills, you all know, treasury bill is a short term money market instrument. Okay, which generally have the maturity of less than 1 year, and it was issued in India for the first time in year 1917 with the three terms: 91 days, 182 days, and 364 days. So 260, 273 days maturity is not covered under the treasury bill. So it was introduced in 1917. It is a short-term money market instrument. Okay. It is introduced in three maturity period: 91, 182, and 364 days. Okay. Done. Okay, so this is it for today. I hope that you all liked the session. I hope that you all have liked the session. Just please share the session also. And if you haven't subscribed this channel yet, just please subscribe the channel also and press the bell notification icon. Okay. Thank you so much. So, see you tomorrow again at 9 a.m. with the rest of the question. Till then, take care, everyone. Thank you so much for joining the session. Thank you so much. Bye bye. Take care, everyone. Bye, guys. Take care.